Welcome to the Live Big podcast, where real estate expert Nick Paynes shows you that everyone can build wealth through real estate investing. Nick and his featured guests will give you the tools, resources, and expert information you need to leverage real estate into a wealth building strategy, so you can stop worrying about your 9 to 5 and start to live big. Here's Nick with today's episode.
Welcome back, everybody, to the Live Big podcast. Question for you. Have you ever wondered how people just acquire massive amounts of real estate or just generate tons and tons of cash flow or just build just tremendous amounts of generational wealth? Today, we're going to talk about that a little bit, and we're going to try something a little bit different. So I talk about this concept so much that I haven't even put together any type of template for the episode. So we'll see how well things go today. But I talk about this a lot, and I have a kind of I don't want to say it's definitely not a trademarked concept by any stretch of the imagination. I'm sure other people have used this name before, but I call it the trade up, trade often method. And so we're going to talk a little bit about overall how you scale in real estate. Okay. And so the reality is, and I think in one of my past few episodes, we talked about the fact that people don't, unless you're some type of athlete or trust fund baby or somebody who's just made a bunch of money somehow, nobody buys $1 million home for their first house. So, how do you do that is you purchase a property and you allow that property to grow and build equity. And then you sell that property and take all that money and put a big down payment on a bigger property and continue to move up. And a few years down the road, maybe you're in $1 million property, you're in $1.5 million property. And then you look at people like, oh my gosh, how do they own a $5 million property? Well, first of all, they probably didn't buy it when it was $5 million, right? They bought it when it was $2 million. And they did that by selling their $1.5 million property that had $1 million worth of equity in it. And they went and put $1 million down, right? So anyway, it's a cyclical process that you're just trading up. You're just going from one to the next. So how do we do that in investment real estate, right? That's like the next question. Is like, how do we do that to scale when we're looking for a wealth building strategy? So one of the things that I teach for people is, and we talked recently in our episode with Clayton, we talked about the benefits behind stocks versus the benefits of real estate. And one of the things that we kind of came to a conclusion upon was that if you're looking to just do maybe, invest $100,000 and be done, maybe buying a rental real estate property isn't necessarily for you. There's other ways to do, to invest $100,000 and get great returns. But if you're willing to take that equity that you make on that first property and roll it over and do a second property and a third and a fourth and a fifth and just continue to push the envelope with the assets that you have, you've got a much better opportunity in that case to build a really high amount of wealth in comparison with the stock market, right? So that's kind of the conclusion that we came to, right? So what we're talking about today with the trade up, trade often method is the idea behind buying your first property and allowing that property to give you the opportunity or to create the opportunity to turn that into 2 properties or to turn it into a duplex or to turn it into a quadplex or whatever it may be and increase the amount of doors that you have. And through this trade up, trade often method, we want to make sure that we're truly trading up, that we're creating a tangible net benefit from that trade, right? So let's take an example. Let's say you go out and you buy your first single family residence rental real estate, or even if you just turn your first property that you lived in and you house hack and live in your first property, then turn it into a rental. And let's say that property is worth $400,000, right? If you were to sell that property and exchange it into something different, you would have to have a net tangible benefit, right? So you wouldn't sell that property and exchange it into another $400,000 property for the same amount of cash flow. It doesn't make any sense, okay? So what you would want to do is you want to sell that $400,000 property, and let's say that $400,000 property you bought for $200,000, okay? And let's say, you owe 150,000 on it. So now you have $250,000 worth of equity. Well, the idea is twofold, is either A, you sell the property, you net two and a quarter, something like that. And you go out and you put two $100,000 down payments on two properties at $400,000. That would be 25% down on each property. And now you own $800,000 worth of real estate. Now you would have $600,000 in loans instead of 150. Okay. So your total net worth wouldn't change at all. Okay. So you don't go down. You just moved equity from one piece of property to another. So your net worth doesn't go down. And hopefully your cash flow doesn't go down. You may have been cash flowing a lot in the first property, and now you're just going to cash flow two smaller amounts that add up to be about the same. Or you might even take a negative hit, but your big benefit is now you own $800,000 worth of property instead of $400,000. Okay. So we've talked about this in compounding, the practice of compounding in previous episodes, where obviously, $400,000, appreciating at 10% per year versus $800,000 is a big difference. It's another $40,000, right? And if you do this over and over again, and then you wait a couple of years with that $800,000 property, or two properties worth $800,000, and wait till they become worth $1.2 million between the two of them, and you do the same thing. Okay. The other opportunity is don't sell that $400,000 property. The opportunity there is take that $400,000 property and cash out the equity. So when you cash out, some of that equity, you may end up putting $150,000 in your pocket, and then you go buy another piece of property, right? So that's kind of been what we've talked about before. So going from 1 to 2, 2 to 4, 4 to 8, 8 to 16, so on and so forth. So the idea is, depending on where you're investing in some type of model. Okay. And so you're going to be investing in a growth model. You're going to be investing in a cash flow model, or you might be investing in a capital preservation model, right? So it depends on what your goals are. So it goes back to having that initial conversation with, okay, why do I want to own real estate and what am I going to do with it? Okay. So if you're in a growth model, you need to make sure that you're in a growth phase in a growth state or a growth location, right? So Colorado is a great growth state. It's a horrible cash flow state, but it's a great growth state. I know that right now, if I buy a property for $500,000, that in 5 years, it's going to be worth $600,000 to $700,000. That's just the way that our market moves. If I go buy a property for $500,000 in Cleveland, it might still be worth $500,000 in 5 years and might even be worth less, right? So but we're going to have much higher cash flow there. Okay. In fact, and I'm not going to remember all the cities, but a report just came out yesterday that I read that said that that there are only 5 main metro areas now left in the United States where it is actually cheaper to rent than it is to buy. That is cheaper to buy rather than to rent. So Philadelphia was one, Detroit was one, I think Cleveland was one, and I can't remember the other two. And so the idea is, if it's cheaper to buy than it is to rent, that would be an incredible cash flow market. Because what that means is, for somebody going in and buying a property, even with like 5 or 10% down, it would be cheaper for them to pay the mortgage than it would to be to rent. So if you went in and bought that for 20% down or 25% down, the mortgage would be even cheaper and the rent would still be up high. And so you'd have this nice, $500, $600 to $1,000 a month cash flow. So in those markets, those are great cash flow markets, but they're generally not going to be great appreciation markets. So one of the things to take into consideration when we're looking at, okay, are we in a capital preservation? What do we want out of our money? Capital preservation, that one will be a little bit different. And that one, we're going to use more some of the tax advantages that come along with, and the tax strategies that come along with real estate. Okay, so we get into that in some other episodes. We won't talk as much about that today. So we're figuring out, okay, do we want a cash flow model or do we want to have an appreciation model? Again, just to reiterate some of the things that we've talked about in the past, your growth model, in my opinion, is something that you should take advantage of while you have a good paying job, something where you don't need income to be generated from the rental properties. Okay, if it is generated, that's great and that's a nice plus, but you don't need it. You're just in an acquisition phase. So your goal is to acquire as much real estate as possible and to acquire as much good debt as possible, right? And low interest debt, right? So anytime we have a low interest climate, we're trying to refinance all of our properties down and get better interest rates on them. Okay. And we're trying to borrow that money so we can go out and purchase more assets with it. Okay. But if we're in the growth phase, we want to make sure we're in a growth state or in a growth location where we know we're getting the benefit of that leverage that we're putting to work. Okay. So once we do that, the overall consensus is like, okay, let's say we do it here in Colorado. Okay. We buy property number one, we either refinance it or we sell it and go into property, and go into two more properties, and then wait a couple of years and let those two properties do the same thing and go into four properties, right? And all the while, what we're doing is we're taking advantage of some of the tax strategies that are available to us, okay? So a 1031 exchange is what we use to exchange rental real estate, okay? And you don't have to use it. And there's other strategies to offset that tax via just taking losses on other properties. So cost segregation is very helpful with that. So front loading a lot of your depreciation. You can sell your property without doing a 1031 exchange, go buy something new and just take a big depreciation hit on it in the first year to offset your gains of your sale. That's one of the things that you can do. But in general, we talk about doing like a 1031 exchange. And the 1031 exchange, what it does is it allows you to sell a property that should be on the hook for capital gains. So let's say you bought the property at $400,000 and you're selling it at $500,000. Okay, you're going to have $100,000 capital gain minus any expenses that you have for the sale of the home, et cetera. Okay, but you're going to have that capital gain there. Now, long-term capital gains are taxed at the federal long-term capital gains rate of currently of 15%, but it's also subject to your state tax and also depending on where your personal income levels are, potentially subject to FICA. So generally speaking, long-term capital gains tax, at least here in Colorado, end up running somewhere between 22 and 26%. Okay, so it's a good chunk of change. If you have $100,000, you're going to end up paying, call it $25,000 in taxes. What a 1031 exchange does is allows you to take those capital gains, that $100,000 in capital gains, and as long as you purchase another piece of property, okay, you have to identify that property within 45 days of closing of your first property, okay, and you have to close on that new property within 180 days, okay? So you have an identification period of 45 days and you have a closing period of 180 days. As long as you move those funds from property number one to property number two, following those guidelines and some other financial guidelines, okay, then what happens is you get to defer that tax, okay? So it's not a tax exemption, but it is a tax deferment. So what you get to do is you defer that $25,000 in taxes. If you can defer $25,000 in taxes, keep in mind that can help you buy an extra $100,000 worth of property or $125,000 worth of property. So it's really significant, okay? Allows us to go out and increase the amount of assets that we purchase. Think about if you just did a 1031 exchange 10 times over your life and each time you saved $25,000. Okay, it would allow you on a compounding basis, you can't just take 10 times 25 and call it 250,000. It would be on a compounding basis each time, because the second time you're going to save more than 25,000. You're going to save, whatever the number is on the second property and the third property. So imagine being able to defer, somewhere in the neighborhood of $500,000 worth of tax. And in the meantime, you take that $500,000 that you should have paid taxes and you buy more real estate with it, again, leveraged, that can allow you to buy $2.5 million worth of real estate. So just the tax deferment alone can help you pick up another $2.5 million of real estate over a period of 10 transactions, which even if you did a transaction every 5 years for 50 years, you're looking at an extra $2.5 million in real estate that you picked up, right? So just the deferment alone can be really powerful. And there are some opportunities to get a full tax exemption. So if you're house hacking, okay, making sure if you live in the property 2 of the prior 5 years, you get a personal property exemption. As a single person, it's $250,000. As a married couple, it's up to $500,000. The first $500,000 of capital gains on your home, as long as you lived in the property 2 of the prior 5 years, you get tax free. So live in a property for 2 years, rent it for 2.5, and then sell it in that right after that 2.5 period, sell it. And any of the gains that you have, you're locking those in tax free. Okay. You're not deferring them. You're not kicking the can down the road. They're completely tax free. So now you're moving all that money into the next property, which could be, again, something that you live in if you'd like to. Okay. Or it can be investment property. But all of a sudden we've locked in that, say $500,000, that piece will never be taxed. Okay. So the 1031 exchange allows you to defer these gains and push them down the road. The second piece that helps you defer your taxes is the depreciation of the property. So when we're buying property, just in general, one of the benefits is the tax strategy of making income or cash flow on the property, even if it's small, but doing it tax-free. Because in real life, we may have some money, we may have an influx or a positive cash flow into our bank accounts, but on paper, when we file our taxes, by the time we put in, mortgage interest that's paid, taxes, insurance, expenses on the property, and then factor in depreciation, the reality is we're likely showing a loss on paper. So now we've got that cash flow coming in tax-free. Okay. Now again, both the depreciation and the deferment of the prior home's capital gain, those are not exemptions. So they're pushed down the road. And when you sell the property, you have to recapture that depreciation that you put in. Okay. But again, if you do the 1031 exchange, it just pushes all that into the next property. Okay. So you continue to exchange over and over and over again and keep pushing that tax can down the road until eventually either A, you want to liquidate all your properties and, end up in a nice financial situation. Okay. Or you hang on to those properties, put them in a trust, put them as part of your kind of legacy portfolio and pass them down to your kids or whatever heirs that you have. Part of what we have in the current tax code is something that we call step-up basis. Step-up basis allows you to pass property onto your heirs, and they get to acquire the property at the current valuation. Okay. So if you bought a property for $100,000 in 1992 and then died with it in 2022, and the property is now worth $600,000, if you sold it 2 weeks before you died, you'd be on the hook for capital gains on $500,000. Okay. So you'd owe somewhere in the neighborhood of $125,000 in taxes. Okay. Or you wait, you pass away, your kids get the property. It automatically becomes valuated at what they acquired the property at, which is $600,000. They turn around and sell it. They make the same $500,000, but there's zero tax involved. Okay. So that's the way that the current tax code is written. So obviously we can't look into the future and know if step-up basis is still going to be there, but that's the way things look right now. So you can just hold these properties until you die and pass them on. Okay. I teach another kind of method as well, because I'm always about empowering my kids and people involved in my life to make their own money. Like, I don't want my parents' money, and I don't want my kids to want my money. I want to spend everything I have while I live. That's the whole premise of Live Big, right? Like be able to spend your last penny on your deathbed. Like I would love that opportunity, and maybe I'd love it even more to have more than I could even spend, and then I can give it away. I'd love to just donate all my money that I don't spend away, right? But I want my kids to be in a position that they don't need my money and they don't want my money, right? And so one of the methods that I teach is, because not everybody wants to keep all these properties till they die. One of the other things is, when you get to the point where you need to turn all of these assets into a cash flow method, there's a couple of things that you can do. Okay. The first thing is first of all, get yourself out of a growth state. Get yourself out of Colorado. Okay. Let's say you've acquired 10 properties or 15 properties over your lifetime in a place like Colorado. It's time to liquidate those properties and exchange them into a cash flow state. So get out of Colorado, go to cash flow states. something where the value of the asset's not going to really improve a whole lot. Okay. But the cash flow is really nice. And what you do is you buy all these properties in cash. Okay. You exchange out, buy all the properties in cash. Okay. And there are some limitations on this. There are some limitations between a 1031, with a 1031 exchange and how much debt you have to continue to carry over and things like that. But there's ways to work that. Okay. But the idea is to buy a bunch of properties in cash. Okay. And now you don't have any liabilities. You don't have any debts. And the cash flow is just kind of free. Like it's just free cash flow coming in. And if you're doing $20,000 a month in cash flow, you live on that the rest of your life, and you have literally, millions of dollars worth of property sitting out there that you can leave to your heirs again if you want to. Okay. The other opportunity is, instead of getting rid of all those properties in Colorado, is to take the equity that you've built over all the years, okay, in these properties, and start borrowing on it and live off of that. Okay. Again, a really cool thing is if you own $1 million worth of property and you only owe $200,000 on it, you can easily go borrow $500,000 on that property, and it brings your loan to value up to 70%. Very easily done. Now, you're going to pay interest on that money, right? You're going to pay 7%, 6%, whatever the percent rate is at that time. You're going to pay interest on that money. But first of all, the cash out refinance is a tax-free event. So you put $500,000 in your bank account, no taxes. You don't owe anything. Okay. So then maybe you have a monthly payment. If you borrow an extra $500,000, maybe you have a monthly payment of $3,000 a month. Okay. So you take $3,000 per month out of the $500,000 that you put in your bank account and make that payment for the next however many years, right? That's literally like 12, 13 years worth of payments. And you can borrow over and over again. You can just keep borrowing off of the equity that's there, right? So that's another option to create, really in this case, tax-free income later in life. Okay. One of the other workarounds that we can talk about is you can exchange out of rental property later in life. Let's say you're 5 years from retirement and you have some foresight and you're like, man, I'm going to retire and I want to have a beach house in Florida. Sell a couple of your properties, 1031 exchange them into a beach house in Florida, beach house in California, whatever it may be. Okay. So exchange two of your $500,000 properties and go buy a property for $1.5 million. Okay. In Florida, and rent that property for a couple of years. Okay. Could be you could be at a cash flow loss. It doesn't matter. Just rent it. Okay. Rent that property for a couple of years and then retire and move down into that property. Now you move down into this property, live in it. Okay. Once you've lived in it for 2 years, your capital gains just disappear because now you get a personal property exemption. You've lived in the property for 2 of the prior 5 years. So even though you bought it with an exchange, okay, you buy it with an exchange, you rent it for a couple of years, and then plans change. Things change. So you move into the property, and now you don't have a capital gains because it's not an investment property anymore, right? So there's all kinds of kind of tax strategies that you can put to work later in life when you're looking for an exit strategy on everything that you've been building. Okay. But the exchange up, exchange often method means that you need to increase the amount of real estate that you have. You could do it through 1031 exchange. You could do it through cash out refinance and purchasing new property. Okay. There's different ways that you can exchange up and exchange often. But the idea is using the equity that you generate for growth to improve and increase the amount of assets that you carry as a whole. All right. So overall, just kind of a summary of what we talked about, okay, is what we're looking to build when we're looking to build a real estate portfolio or build wealth is that we can't just buy one property and let it sit and do its thing, right? We can't just buy 2 properties and let it sit and do their thing. Okay. The other piece to this that I forgot to mention is we do have something called functional obsolescence in real estate. And what functional obsolescence is that a certain property, okay, takes, each property has a certain kind of lifespan, right, of how long it's truly functional without having to put a ton of money back into it, right? And so the idea is if you can buy a really nice property and you can get some nice rental income out of it, and say in 3, 5, 7, 10 years, can sell it before it needs everything, before it needs a full update. Okay, you can get in and out of a property without ever really having to put a bunch of money into it. But if you keep it for a really long time and you let renters destroy it and you don't keep up with deferred maintenance, you're going to eat all that on the back end anyway. And you're probably going to be in a situation 10 years down the road where you just don't want to deal with it. And then you're going to be one of those people that sells their property for significantly less than it's worth because they just don't want to deal with it. So if you keep up with your deferred maintenance work, you exchange properties enough that you don't run into a place where you're like, man, I really got to, I really have to do a bunch of work on this property. Like, don't even get to that point. Just get rid of the property before that comes. Exchange it. Exchange 1 for 2, exchange 2 for 4, right? So exchange and get a bunch of doors. Okay. Get a bunch of doors, or just create bigger assets, right? So it's okay if you want to exchange in and buy a big property, buy something for 1.2, 1.5 million. Okay. But also keep in mind, as real estate appreciates, some of the things that we have to keep in mind, real estate appreciates differently, and we start pricing ourselves out of normal buyers, right? So we start buying real estate that's worth $2 million, $3 million, $4 million. It's a little bit harder to liquidate. It's a little bit harder to get out of later in life because we don't know what people's financial situations are going to be. Okay. Starter homes are always going to be something that is desirable, right? It's always going to be something that people are going to need to, I need to live somewhere. I need a starter home. And, who knows, down the road, that might be $1.5 million would be a starter home with inflation, right? I think my parents' starter home was $40,000, $50,000, $60,000, right? That's unheard of now. Everything's tenfold that now. So is it unreasonable to think that we might be tenfold where we're at now, 40, 50 years from now? I don't think so. So exchange up, exchange often, and just build your portfolio based on what you're trying to accomplish. So remember, capital preservation, growth, or cash flow. Figure out what that is and what that means to you and why you're trying to do that. And that'll give you the idea of where I should be investing, why I should be investing, okay, and how you're going to do it. But ultimately, going back to the prior episode with Clayton, okay, if you're not looking to build a portfolio out of this, there might be other investment options for you that might be better. Okay. Last piece I'll leave you with is in the event that you get later in your life and you want to create a cash flow model, but you're just sick of being in real estate. Okay. And you don't want to be a landlord. You don't want to hire a property management company. You just don't want to deal with it anymore. There is one opportunity for you to get out of property and into more of an equity, or more into basically almost like a stock, and exchange into it. So you can exchange out of a piece of real estate and you can exchange into what's called a DST. It's a Delaware, I think it's a Delaware statutory trust, I believe is what it's called. And so basically what it is, it's very similar to a REIT, which is a real estate investment trust, which is essentially a piece of stock that it's a company of stock that buys real estate. Okay. And so you can sell your properties and exchange them into a DST, which again, essentially is like valued as shares. You would buy a certain amount of shares of DST. And they generally, while they're not super volatile and they don't have a lot of growth, they generally offer a decent dividend. And so there's kind of the cash flow model that you create. So if you can exchange out of, say, $5 million worth of real estate later in life and purchase a DST that's, say, at 8% interest or something like that, now you're looking at a $400,000 per year dividend model. You're not going to have the write-offs. It's going to be fully taxable, that type of stuff. But again, that's one of your options to exchange into. So anyway, I hope this information was helpful. Our next episodes, we are going to get into some more higher level, real estate stuff, talking about real estate syndication, buying apartment buildings, bigger commercial properties, and how that works. So hope you'll tune in next week so you can kind of understand. And it's a good place for you it's a good thing for you to learn about if you're one of those people that doesn't really want to be a landlord, doesn't really want to be, owning all this real estate. You'd rather just kind of have your money in real estate that someone else is handling. That's where syndication comes in. So great couple of following episodes on that. So anyway, hope you enjoyed today's episode. Please tune in for the next ones. Check out more information on our websites and give us a call if you have any questions. We'd love to hear from you. And don't forget, go out and live big.
Thanks for joining us for this episode of the Live Big podcast. For even more real estate and investment resources, go to blackyetigroup.com/resources and download Nick's complete guide to running your own rental properties. Tune back in next week for another episode, and until then, live big.
Live Big does not provide investment, legal, or tax advice, and nothing herein should be construed as being financial, legal, tax, or other advice. Live Big does not represent that any securities or services discussed are suitable for any investor. No investment or other decision should be made solely based on the contents or information found on the website or podcast. When making a decision about your investments, you should seek the advice of a professional financial advisor or qualified expert.